Economic double taxation is a situation where the same income is taxed more than once, often at different levels of the financial chain. This typically impacts both corporations and their shareholders. For example, when a company earns profits, it first pays corporate tax on those earnings. Then, if the remaining profits are distributed as dividends to shareholders, those individuals also pay tax on the dividend income they receive. This means the same profit is taxed twice, once at the company level and again at the shareholder level. The result is a higher effective tax rate on the original income, which can reduce the returns shareholders ultimately receive. Understanding this concept is crucial for anyone involved in business or investing, as it directly affects how much income is retained after taxes. Let's break down a practical example to see how economic double taxation works. Suppose company A earns rupee 100 crore in profits. First, it pays a 25% corporate tax, which amounts to 25 crore. The remaining rupee 75 crore is then distributed to shareholders as dividends. Shareholders, in turn, pay a 10% tax on this dividend income, which is rupee 5 crore. Oh, the original rupee 100 crore profit is taxed twice, once through corporate tax and again through dividend tax. This double layer of taxation means the total tax paid exceeds the corporate tax rate alone, ultimately reducing the net income shareholders receive. Such scenarios highlight why double taxation is a significant concern for both companies and investors. Reduce the impact of economic double taxation. Many countries have put systems in place. For instance, some use imputation systems like in Australia and the UK, where shareholders receive tax credits for corporate taxes already paid. Others, such as India, have reduced dividend tax rates for listed companies. In 2020, India abolished the dividend distribution tax (DDT), shifting the tax responsibility to shareholder. Now, dividends are taxed at a flat 10% rate for listed companies, or according to the shareholder's tax slab. Additionally, Section 80M of the Indian Income Tax Act allows companies to claim deductions for dividends received from other Indian companies, helping to avoid cascading taxes. Double taxation avoidance agreements (DTAs) with other countries also help prevent international double taxation, ensuring fairer tax treatment for cross-border investors. Section 80M is a key provision in India's tax law designed to prevent double taxation of dividends among Indian companies. Here, how it works. If Company X receives a 50 crore dividend from Company Y and then distributes that same amount as dividends to its own shareholders, Company X can claim a deduction for the 50 crore it received. This means Company X's taxable income is reduced by the dividend amount, effectively avoiding double taxation on the same income within the corporate chain. This provision is especially important for holding companies in large corporate groups, as it ensures that profits are not repeatedly taxed as they move through different entities. Section 80M, along with DTAs and the abolition of DDT, forms a comprehensive approach to minimizing economic double taxation in India.